Stop, don't skip this. Over the past 2 weeks, Turkey has dumped 58 tons of gold. At the same time, Gulf funds have been quietly pulling physical bullion out of London at a pace not seen in nearly 70 years. This isn't noise, this is systemic selling pressure. And right as that's happening, oil prices are surging beyond control. A combination the market is deeply uncomfortable with. Because the market doesn't fear gold going up. It fears gold going down while everything else is heating up. But that's not even the most important part. There are two industries, almost never discussed on television, that are absorbing institutional capital at a speed you rarely see in any cycle. And if you understand what's really driving all of this, you're looking at a setup that could shape portfolios for the next decade. If not, you'll be standing on the sidelines, watching it unfold just like every time before. In the next few minutes, I'm going to show you why this gold sell-off is not the end, but the beginning of an opportunity forming. I'll walk you through the two sectors where big money is quietly flowing right now, and more importantly, why it's happening. And I'll take you inside the exact framework Wall Street advisors use to position themselves before the crowd even realizes what's going on. Because what I'm seeing right now, a large-scale wave of gold liquidation, a spreading oil shock, and capital flowing into places no one is paying attention to. That's not a coincidence. That's a setup. The kind of setup I was trained to look for before the market reprices everything. Now listen. I know you might just want to know what those two sectors are and which one you should buy. Everyone wants to jump to the conclusion. Everyone wants to get rich by Friday. But that's not how real capital moves. I'm not here to tell you what to do. I'm here to show you how they think. And if you truly want to understand, to see value before it becomes obvious, then first, you need to understand the framework. Because Wall Street doesn't look at the market through one layer. They look at it through three. Stop. This is how Wall Street actually sees the market. There are 3 layers, and if you can't see them at the same time, you miss the entire picture. Layer 1, forced selling. This is not a story about weak demand. This is pressure, margin calls, liquidations. Institutions are being forced to sell, not because they want to, but because they have to. And this is where opportunity begins to appear. That's why I look at these sell-offs in gold and silver with a level of calm. Layer 2, long-term fundamentals. This isn't about the short term. It's about structure. What's changing globally? Middle East tensions, rising oil prices, the ripple effect into energy, industry, and real demand. Big money doesn't think in weeks. They think in years. Layer 3, innovation. This is where breakouts are born. Technology emerges, institutional capital moves first, then the public follows. Always the same cycle. Always the same wave. Think of it like a shopping mall. 3 sales happening at the same time. Forced liquidation, structural expansion, and a new trend forming. The question is, which layer are you standing in? And the third layer. That's when a new store opens. A new trend, a new technology, something that didn't exist before. 3 layers. 3 types of opportunity, and smart investors see all 3 at once, while most retail investors only see one. So I'm going to show you how all 3 layers are unfolding right now, and how to position for each of them. If you've ever recognized a major move after it already happened, remember that feeling. That's exactly what this framework is designed to eliminate. Because Wall Street doesn't guess, they operate on systems refined over decades. And this brings us to the first layer, forced selling. Turkey just sold 58 tons of gold in 2 weeks, the sharpest drawdown in years, to defend its currency amid tensions with Iran. At the same time, gold outflows from London reached roughly 45 tons. Gulf funds quietly selling. This is not a loss of confidence. This is a liquidity crisis, a margin call at the national level. They're selling to survive, not to abandon gold. And that's why the first opportunity is still gold and silver. Listen carefully, this is the point most people miss. Silver is not just a monetary metal, it is 2 stories in one: investment and industry. Gold, primarily a store of value. Silver, it is both money and a material the modern world runs on. And yes, it's more volatile, but industrial demand has not disappeared. It's still there, if anything, It has outpaced supply. No major new mines. No meaningful expansion. Meanwhile, the world is running short on both gold and silver. Try buying physical. Ask about delivery times. You'll start to see the problem. And when nations are forced into liquidation, price does not reflect value, it reflects liquidity pressure. That is when assets become undervalued. Meanwhile, the long-term drivers are still intact. Central banks are still buying, the dollar remains under pressure, and de-dollarization is re-emerging. And the new capital flow. It's moving into a place almost nobody is talking about, coal. Because when oil gets expensive, everything changes. Coal comes back as a cheaper alternative for energy and steel production. That's how big money moves, not through emotion but through cost, necessity, and reality. Look at Europe. You're seeing a paradox the market hasn't priced in correctly. Gas reserves are falling to dangerous levels, and now running coal power plants is cheaper than gas. Yes, you heard that right. While Germany has shut down its nuclear plants, utilities are turning back to coal. Not because they want to, but because they have to. A stronger coal-burning season is forming. And this isn't just happening in Europe. India, one of the world's largest oil importers, is activating emergency powers to maximize coal-fired power output. Why? Because when oil and LNG become expensive, coal becomes the cheapest way to keep the system running. This is no longer a clean energy story. This is a cost story, and big money. It's reacting exactly to that logic. Why? Because when oil and LNG become expensive, coal becomes the cheapest way to keep the system running. This is no longer a clean energy story. This is a cost story, and big money. It's reacting exactly to that logic. Coal stocks are starting to move in sync with oil, not because of trend, but because of structure. And don't forget, coal isn't just about electricity. It's the foundation of steel, and when infrastructure and defense spending rise, steel demand becomes unavoidable. That's how an energy story turns into an investment opportunity. Think about it simply. Every bridge, every skyscraper, every military vessel, every railway, they all require steel, and you cannot have steel without coal. That's why this is a contrarian trade. For years, coal was considered untouchable because of the climate narrative. No one invested. Supply was constrained, but demand? It's coming back. And that's when big money starts to move. When assets are still cheap, but the fundamentals have already shifted. But that's not all. The second wave, biotechnology. This is the innovation layer I mentioned. Capital is flowing in, billions in just a single quarter. Major pharmaceutical companies are committing hundreds of billions to R&D. Why? Because a patent cliff is approaching. Between now and 2028, around $300 billion in drug revenue will lose protection. When that happens, revenues can collapse by 80% overnight, and the big players don't have enough pipeline to replace it. So what do? They acquire. Why? Because a patent cliff is approaching. Between now and 2028, around $300 billion in drug revenue will lose protection. When that happens, revenues can collapse by 80% overnight, and the big players don't have enough pipeline to replace it. So what do? They acquire. They hunt for small biotech companies and pay premiums to fill the gap. That's how assets get transferred. And if you see it early, you don't chase the market. You move ahead of it. Listen, this is where the opportunity becomes real. You can start simple. Ask the right questions. Build a watch list, verify everything yourself. Even the stocks I'm watching, that doesn't mean you should buy them. Everyone has a different risk tolerance. But there are two forces you can't ignore. First, capital flows. Hundreds of billions are moving into pharmaceuticals and biotechnology. Second, AI. Artificial intelligence is cutting drug development costs by up to 40%. What used to take decades can now be compressed into a single year. Fewer people, faster timelines, more opportunities. But don't get it twisted. This is a high-risk space. Failure rates can reach 90%, so you have multiple approaches, large-cap companies, more stability. ETFs like SPDR S&P Biotech ETF, XBI or iShares Biotechnology ETF, IBI. For diversification, or selectively picking small-cap names, higher risk but greater upside. But always remember, keep allocations small, control risk. Because in this industry, the U.S. Food and Drug Administration can delay approvals, trials can fail, politics can intervene, and that's the game. High risk. But the rewards go to those who understand the structure before the crowd sees it. Listen, this is the part you really need to understand. Biotechnology is not for everyone. High volatility, high risk, nothing is guaranteed. But what's happening beneath the surface? Real capital, real momentum, a structural shift. So what surprises you more, coal or biotech? Because this isn't random speculation. These are the same patterns Wall Street advisors have used for decades to track how big money moves. And once you start seeing those flows, your decisions begin to change. Remember the three layers: temporary disruption, gold and silver; structural shift, oil and coal; innovation, biotechnology. Three stories, one moment in time. And me personally? I'm watching all three. If this opened a new perspective for you, share it. Because right now, as oil just touched $115 per barrel, Bank of America has just sent a new report to institutions. And this is only the beginning.